Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button if you haven't already. Well, last month, the Core Personal Consumption Expenditure, or the PCE Price Index, which again strips out food and energy costs, it's also data that the Fed watches very closely, ticked up just 0.2% last month, marking the smallest gain this year. Meanwhile, consumer spending dipped unexpectedly, indicating a possible pullback in economic confidence. Now, traders are watching data very closely here, giving some hope of a rate cut before the end of the year. So what does this mean for your investments? And is it time to brace for a slowdown, or is this an opportune moment to adjust your portfolio? Well, that brings us our next guest, Chris Vermeulen, founder and chief market strategist of the Technical Traders. Now, Chris often highlights the pitfalls of overreacting to immediate economic data, arguing investors should be looking at the long-term picture here. Hey, Chris, welcome back to the show.
Hey, thanks, Jeremy. Always a pleasure.
Yeah, let's talk about this a little bit. Let's get into the economic data. You know, we showed a cooling in the core PCE and a small downturn in consumer spending. You know, there seems to be mixed signals in the market. Some say the markets are a little too quick to price in multiple cuts. How do you interpret this data in relation to the overall market health here, Chris?
Yeah, I believe the general public or general market participants are always way too sensitive, way too jumpy in terms of piece of news comes out and they overreact. And I think we're seeing some selling today, or as you and I are recording this, people are a little worried about that number coming out. And I think it's just an overreaction. The underlying trend for the stock market is still to the upside right now. I do feel like it's kind of on its last legs, but I never really get too excited about any move that happens around news, even if it's in favor of what we want, whether it's higher or lower, just because it's an emotional move. It's algos. It's just a bunch of people trading around the news, trying to think that they can outsmart it or know what's going on. So anything around news, you really just have to give it a day or three, let the dust settle versus get caught up in the news, which I consider, economic data and a lot of that stuff can be a lot of noise, especially if you get a lot of different opinions out there. You kind of get analysis paralysis. So you kind of have to step back, and I'm a technical analyst, so I like to follow price, and price is going to tell us whether we need to be long, stay long, or bet on the downside.
Right. Well, I mean, when we look at it, on the one side, we have consumer spending slowing down, though, and this could be seen as a bit of a warning signal of a potential slowdown. But on the other hand, it might provide the market with this necessary adjustment period. So what's your perspective on this? Do you view it as a cause for caution, or is it time to recalibrate?
I definitely think things are slowing down. I mean, we can look at a couple different charts here that actually show it very well. If we take a look at this unemployment chart, so this is like a 24-month moving average, and more or less, whenever the unemployment starts to move up past one of these red lines here, we tend to have some type of recession, financial crisis of some sort. And so we have done that. And it makes sense because people are starting to get unemployed. So spending is going to go down. Another really key piece of data here is, there was a huge amount of excess savings in people's bank accounts. Going in from COVID, there was a huge bubble. Everybody had done very well. But now there's less savings in bank accounts than there was pre-COVID. So people have burned through their capital. They have been living the high life, thinking things are going to stay really good for a long time. The reality is people are running out of money. This is probably why consumer spending is starting to go down. We're going to see a downtick. And we're probably going to see, credit and debt start to rise, which there's big interest rates. All these things are very slow moving indicators telling us that the economy to me is slowing. And spending is going to slow, which means lower sales for companies, earnings go down, and it's a big vicious circle. Eventually layoffs, real estate goes down, right? So it's this huge kind of everything's tied together, but these things really stand out in terms of why maybe spending is starting to go down. And with inflation, I mean, this definitely hurts people's bank accounts. You can't buy nearly as much as you could a few years ago with the same dollar.
Mm-hmm. Yeah, no, a lot of people are struggling right now. You've talking about the technical side, you've always kind of emphasized the significance of long-term charts, such as monthly and weekly. We keep talking about this economic narrative. We get so much of it every day. Talk to me a little bit why you look at these longer terms instead of maybe a daily or an intraday chart. And is this how you kind of cut through that noise that we talked about?
Yeah, I think it's really important to look at the long-term chart. So we could look at the weekly chart of the SP 500. And I like to look at the stock market, pretty much every market, as an ocean tide. If the tide's going up, it lifts all boats. If it's going down, most boats go down. And the key, this is the weekly chart of the SP 500. The key is to identify when the overall tide is going up. That's when you want to own equities. When the tide is naturally going down, you want to be very defensive and probably not in equities. And we're back into a rising tide environment right now. Now, this is for the large cap stocks. This is like the SP 500, the NASDAQ. There was a very different picture being painted with the Russell 2000 and the majority of sectors that actually show a much more bearish picture. And that's because they're much more sensitive. They usually top out and reverse well before the stock market does. And there's a really good way that I like to visualize this, which is through stage analysis. And if somebody understands there's 4 stages to a market, a basing stage, which is a sideways, dormant, difficult time to make money. Stage 2 is a bull market. Stage 3 is a topping phase, which is where I believe the markets are right now. And then stage 4 is a financial reset. I believe we're headed towards a financial reset in the next few months. And there's a bunch of early warning indicators that are starting to flash on the charts from a technical standpoint that we are getting very close to the markets running out of steam. And if you take a look at this, Jeremy, this kind of blow off top move and this sideways move, this complacency move, I call it. This is where a lot of people feel like the stock market is regaining traction and that it's going to want to go higher, the general public. But the reality is it's most likely, going to fail and go to the downside. And a really good visual of this is actually the Russell 2000. If we zoom out here on the Russell 2000, which is a great leading indicator, you can see it has had a very big rally, blowing off to the upside. And now it has this kind of complacency move that eventually I believe is going to fail. And we're going to see a big correction. And this is that stage 3 topping phase I just showed you on that other chart. And this is what the majority of stocks are doing. The NASDAQ and the SP 500 are hitting new all-time highs, really kind of camouflaging what's happening behind the scenes. AI, big tech has drifted those indexes to new highs, making people blind to what the reality is of most stocks, and the strength of the market is not nearly as strong as people think. And it's going to be a pretty rude awakening when the event rolls over and we go into a big stage 4 decline in the markets.
Right. So what cycle are we in then? I mean, I hear you saying we're a little bit at the top of the cycle. I mean, we saw NVIDIA's revenue surge. And I guess the question is, on the Mag 7, we're looking at the S&P, kind of the tech side AI. Is there a top here in that narrative too? I mean, are eventually these earnings just going to kind of dwindle or maybe stay the same?
Yeah, when it comes to AI, I mean, it's a pretty big wild card. I don't follow AI too specifically, but there's no doubt we are still in the infancy stage. I mean, NVIDIA, who knows how much potential it's got? I mean, now that AI is so big, requires so much power, it's probably going to open the doors to a whole bunch of new potential video card companies that are going to want to try and get in this space, because it really is just beginning. But AI has got potential to keep growing. It might be that one sector or the one group of stocks that could potentially hold value or maybe buck the trend and keep going up, even if we have a market correction. But Jeremy, if we look at the overall stock market, we've got some really interesting cycles at play. So this blue cycle here is the stock market cycle. The yellow one in the background is the economic cycle. Now, the stock market tops out generally 3, 6, 9 months before the economy does. And what I want to point out here is typically near the top of a stock market, just before it's about to roll over and more or less die, we see precious metals come to life. We see energy come to life. And we see industrial capital goods, which I'll touch on in a minute, because it's actually really interesting and most people don't pick up on this. But we are seeing gold hitting new all-time highs. We're seeing the energy sector. Like if we go to gold real quick and take a look at the charts, we obviously have gold pushing up to new all-time highs. The big long-term picture of this is very bullish. Savvy investors are moving to safety, and gold is one of those. Another one here is the energy sector stocks. And while it may not look like it's been screaming higher, in reality, long-term, energy sector stocks are almost at all-time highs. They have been muscling their way up. And that's because these are commodity-based. We've got wars going on. Typically, energy and gold do well during war. They also do well just before a stock market tops. And so those are two major things. And I really like precious metals. I think gold, silver, miners have got potential to run for a few more months before they might start to get pulled down with the stock market. So that's kind of my take on those. There is this really interesting angle around industrial capital goods. So this is this is where I think there's a big disconnect. You've got CEOs, you've got factory managers. They've had amazing sales since COVID. Everybody's in this bubble phase. Companies are making record profits. So these factory managers are upgrading their assembly lines, their equipment, their machines. They're spending millions. And there's a huge delay when they order this type of equipment. It takes a year or two to get delivery. It takes forever to install. And this is the example of what the typical kind of business person is doing on this yellow cycle. They're really ambitious right now. They still think we're having a little slowdown in business, but their business is booming and strong. They don't realize we're about to walk into a recession, and they still think we're in this expansion phase. And so they're all going to, employ or bring all these new assembly lines in with huge interest rates, huge margins or markups, or interest rates. And then we're going to go into this recession, and then they're going to be kicking themselves saying, why didn't we just keep our old assembly line? It was paid for. Now our demand's down. We could have run. So that's the interesting phase and that tells us we're kind of in this hump here between the stock market topping and the economy getting very close to a pullback. And when we look at the industrial goods sector, you can see here, it is screaming up to new all-time highs because all these factories are upgrading, thinking they're going to be rich and they're going to have amazing earnings, but they don't realize they're spending all this money just before we're going into a down cycle that could last 2, 3, 4, 5 years. Because I actually believe we're very close to a 2000 tech bubble type of scenario because commodities, the commodity to equity ratio is at all-time lows, meaning stocks are the most valued they've ever been. Commodities are the most undervalued they've ever been. And that is very similar to what happened during the tech bubble. Same setup.
So how long do you think until we start to see this? I mean, you mentioned 3-4 months bullish on the metals side, specifically gold. When the markets come down, it's not that sell and may go away. When the markets come down, everything else is kind of cyclically going to top it as well?
Yeah, so I think by the end of this year, we're going to probably be in a very deep sell-off in the markets. I don't know if we'll have fully started a stage 4 decline. We need a lot of downside damage before that huge trend has changed. But I do think we're going to see a big pullback in the markets. And let me just see where we're at. Oh, yeah. So there's this interesting scenario here of the commodity and equity ratio where we are down at these crazy lowest levels ever for commodities. And when we saw this back in the tech bubble, that was like a 3-year bear market. And it took forever for the stock market to come back, 16 years for the NASDAQ to come back. So I do think this year is most likely going to be a top in equities. And you need to protect your capital because the buy and hold could be out of favor for a very long time. And there's ways that we can take advantage of this market when it is falling through commodities or through inverse ETFs, or just stand aside and collect interest until the storm kind of passes.
Okay. Well, then this is interesting because, you talked a little bit about that market top and, the potential risks associated with it. Then what are the strategies here, Chris? What do you recommend to investors right now? Is it time to shift towards more defensive assets, or do you see, value in maintaining positions in equities?
Mm-hmm. Yeah, so I'm a huge fan of following an asset hierarchy. So I have a hierarchy that I follow, and whatever's highest on the list carries the most weighting. It's usually the most volatile. I focus on the stock indexes, and I'll move down this list to slower and slower assets depending how the markets unfold. Now, they need to be in favor for us to get long. But for example, we naturally always want to be long stocks. They have the most upside potential. But if the stock market rolls over, we're going to go and look at TLT, which is long-term treasury bonds. I believe they're getting closer to a major bottom, and we're probably going to start to see those rally by the end of this year, and they could have some pretty good upside potential. So my strategy is quite different than everybody else. I don't believe in diversifying across stocks and bonds and a whole bunch of different assets. when it comes to focusing on the stock and kind of commodity markets. I focus on I just want to own equities if equities are in a stage 2 bull market. If they're not, I'm going to go to the next asset. Are bonds starting a new bull market? If yes, I jump into bonds. We're 100% into bonds. We want to ride that up. Forget falling stocks. There's no point of holding an asset going down. So as you said, Jeremy, I like to rotate to different asset classes, and bonds are a different class. UUP, UDN, those are the long and the inverse US dollar index. And in 2022, that was the trade of the year, really was that particular play. If we actually look at the long-term chart here of our strategy, we had 2022 was a down year for the stock market. Well, the US dollar, which is one of the slowest moving, most stable ETFs that I like to play, it rallied 18%. And the biggest pullback along through that year was a 4% pullback. So it's very low volatility, low risk, and you can catch these beautiful trends in currencies. So the key, as you said, is to literally just step out of the asset that's now going down and step into one that is going up. Or if none of them meet the criteria, we'll actually just move to like a money market or a cash equivalent that pays us literally daily or monthly dividend payments as cash. It's sometimes better to make a 3% return a month and make your 4% a year sitting on the sidelines than it is to lose 4 or 5% a week for the next, several weeks or during a bear market phase. So it is critical to step to different asset classes as we go. And one thing that a lot of people don't realize, Jeremy, is they look at the stock market and they're like, oh, I'm diversified. I have a whole bunch of different sectors and stocks. I'm all over the place. I'm completely diversified. But my strategy of if the tide is going down, if the stock market is going down, almost all stocks go down. It doesn't matter. And believe it or not, we see a lot of commodities. We see almost everything go down. So it doesn't matter how diversified you are. All of those stock positions you have are probably going to go down. It's just some go down more than others. So I'm a firm believer of if the tide's going down, step out of it or take advantage of falling pricing. Don't get stuck thinking, oh, I have all kinds of different sectors. I'm diversified, because all you're doing is spreading your wealth out among something that's still going down naturally, right?
Yeah. Can you take the trade though, Chris? Like, can you pointed out a little bit about certain market segments, specifically small caps and sectors, including the ARK ETF. They're currently underperforming. If this indeed happens, are you putting your money into other areas, maybe emerging markets, somewhere where you can see a bit of an upside when, all the dominoes start to fall?
I know, because generally, if you go and look at all the global indexes, when the US markets, like I found the SP 500, if you can identify the trend and the money flows of the SP 500, you've pretty much identified almost every stock and every stock index around the world. They almost all follow suit. They're not perfect. Yeah. There's the odd one that will buck the trend, but why try to pick the one when the odds are with you to just play the downside? So I wouldn't move to emerging markets. I personally just love the US equities markets. There's the volatility, there's the liquidity. I'm just comfortable with it. And it seems to kind of be the engine. If you know what the SP 500 is doing, you know what the rest of the market more or less is doing, in my opinion. So when the market turns down, I believe, you need to find an inverse ETF to benefit from the natural, month after month lower pricing, or you need to move to a different asset class that goes up. And, the ARK ETF, for example, I have on the chart, you can see it's gone through the entire stage 1. It had a stage 2 blow off. It had its complacency move. It went into a stage 4. Now it's back into, a lot of people think this is a stage 1, that the whole cycle is going to rinse and repeat. I actually believe, we're going to go into a much deeper recession, and we're going to see this down into the $20 or the $16 range, because this is actually a large bear flag pattern pointing to lower pricing. So I don't believe that this is a way to get in. I know a lot of people are loading up on the ARK ETFs, looking at this cycle, saying, okay, we're back at a bottom. But there's a lot of downside risk. There isn't a whole lot of safety. There isn't a stock you can really move into, or stocks that will buck the trend if we go into another bear market.
Okay, talk to me a little bit about, the investment philosophy. Yours usually prioritizes price trends rather than predicting market moves, kind of like what we talked about. I'm curious, how responsive is this approach to sudden market shifts? Is there triggers or something strategic where you go, okay, I'm going from bullish to bearish, and that's my stance, or vice versa?
Yeah, good question. Well, the strategy that I follow, it's more or less kind of like position trading, meaning trades can last several months. We got long last November. It lasted all the way up until really just about a month ago. So we can catch trades and trends that last several months, big returns. The strategy, like I look at the stock market like the ocean, and there's waves that roll through. And you look at like a surfer, out past the break, they're sitting out there floating, waiting for a clean set of waves to roll through. That's what I do in the stock market. I have a strategy. We can identify, we see these momentum waves rolling through a sector or index or asset class, whatever it is. And then we pick the one that fits our risk criteria, one that we know well, and we hop on that wave and we ride it. So we don't try to predict anything. There's no point in trying to predict. What we do is identify trends that have lots of power behind them. We hop on that trend, we ride it. And the nice thing about jumping on something that has got strength is we also know when it's starting to lose its strength. So we can start trimming off profits. We can move up our stops. And if we just wait, Jeremy, for these waves that roll through every year, there's about 5 to 12 trades. Just think 5 to 12 waves that roll through the market. And we just pick the ones that fit our strategy. So we're not active as an active trader. We don't have a lot of trades, but we're definitely not a passive investor sitting on the sidelines, just riding these storms, these waves out. We're just hopping on, catching a wave, carving off, waiting for another one. And we sit in cash about 4 months of the year. If you were to accumulate all the times we sit in cash, we're in cash and we collect monthly interest, a third or more percent every month, just sitting in cash safely, waiting for that next wave to roll through.
Yeah, Chris, are you watching the metal prices in comparison to the mining equities and that misbalance? Is there anything you're jumping into to take this upside that you say is maybe 3 to 4 or 5 months of upside here? Any insight into some of those specific equities?
Yeah, so we're long SILJ, which is the silver miner juniors. I'm heavy long in physical metals. I have been for a long time. I slowly accumulate more and more. I do believe I'm a huge fan of physical metals. I think there will be a time, probably next year, hopefully next year, where the financial markets reset. It'll pull the miners down and precious metals as well, which they almost always get pulled down during a bear market just because of panic selling and forced liquidation, all kinds of things. I believe after this next market pullback is going to be like the ultimate buying opportunity for physical gold. And even more so, it'll be that rare opportunity you see like once every 10, 15 years in miners where you can pick up miners for pennies on the dollar, catch them for like hundreds or thousands, or tens of thousands of percent, like huge. And I mean, anybody who's caught one of these gold runs from like 2002 or 2009, kind of 2008, where they put in a bottom. I mean, we've been drooling for the next one, and I believe it's coming. Hopefully within the next one. So I will be looking at gold miners, specifically long-term holds, once we have a market correction. Right now, it's a short-term play. We're just trying to catch a move up in the precious metal space because I do think that will be coming back down a little bit in due time.
In due time, as things do happen. And it's healthy to take some profits. Hey, thanks for this, Chris. I appreciate it. Chris Vermeulen from the Technical Traders joining us today. Great insight here. We'll have you on again soon.
Thanks, Jeremy. Always a pleasure.
Thanks, man. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. Don't forget to subscribe, of course. Go tell your buddies, and be sure to leave a comment of who you'd like to see on the show next. We'll see you next time.